Advisories on predatory and subprime lending. The growth of subprime lending products during the late 1990s prompted federal banking regulatory agencies to caution lending institutions about the risks involved in these activities. Subprime borrowers are those with weakened credit histories or reduced repayment capacity. Loans to these borrowers historically have had a higher delinquency rate. Many lenders have expanded their lending programs and added subprime products as a method of meeting their Community Reinvestment Act responsibilities by providing greater credit access to lower-income consumers. Regulators raised some safety and soundness concerns, especially where institutions had subprime lending programs with credit exposure greater than 25% of their capital. While most depository institutions lend in a fair manner to subprime borrowers, some lenders take advantage of them by engaging in predatory lending practices. The banking agencies issued two guidances on caution depository institutions about risks involved in funding non-depository lenders that engage in predatory lending. Predatory and abusive practices include high-pressure sales, fraudulent marketing tactics, excessive fees and interest rates including fees for unnecessary products, prepayment penalties designed to trap borrowers in the loan, balloon payments that may cause foreclosures, frequent refinancing with fees included in the new loan. Non-traditional mortgage products began to proliferate during the early 2000s as a response to the robust housing market. In 2005 and 2006, the market began to soften. Responding to concerns that the softening market would begin to affect the quality of loan portfolios around the country, the banking agencies issued a guidance in 2006 on non-traditional mortgage products. This issuance covered mortgage loans that have non-traditional features such as interest-only loans or payment option loans that allow the borrower to exchange a lower payment during an initial period for a higher payment during a later period, which causes the loan to negatively amortize. In 2007, with the near collapse of the subprime mortgage market, the agencies responded to a growing foreclosure rate with an interagency statement on subprime mortgage lending to address underwriting and consumer protection concerns. Interagency guidance on subprime lending, March 1999. The coverage is 1. All regulated financial institutions, 2. Subprime loans and loans to lenders or dealers that make subprime loans, and 3. Credit extended to borrowers who exhibit characteristics indicating a significantly higher risk of default than traditional bank lending customers. Part B, Risk Management for Subprime Lending. 1. Planning and Strategy. All proposed activities must be consistent with the bank's overall business strategy and risk tolerances. B. Risk assessment must include operating compliance and legal risks. C. Clear objectives for performance must be set. 2. Staff expertise. Staff must possess sufficient expertise to manage the risks in subprime lending. 3. Lending policy must A. Be appropriate to the size and complexity of the operation. B. State clear goals. C. Address the types of products offered and those not authorized. D. State portfolio targets and limits. E. Provide lending and investment authority for individual officers. F. Provide a framework for pricing decisions and profitability analysis. G. Provide for collateral evaluation and appraisal standards. H. Have well-defined underwriting criteria. I. List procedures for tracking and monitoring loans. J. Require credit file documentation. K. State the correspondent broker-dealer approval process. For purchasing evaluation. What are we talking about? Risk management for subprime lending. 1 is planning and strategy. 2 is staff expertise. 3 is a lending policy. 4 is purchase evaluation. 5 is loan administration procedures. 6 is loan review and monitoring. 7 is consumer protection. 8, securitization and sale, and 9 is reevaluation. So to speak about the purchase evaluation part of risk management for subprime lending, you have to say, A, if the bank purchases subprime loans from other lenders or dealers, it must consider the cost of servicing those assets and the loan losses that may occur. And B, due diligence must be performed before purchase. To speak on the loan administrative procedures that make up risk management for subprime lending, you must consider A, the bank must monitor the performance of subprime loans, B, collection procedures should be in writing, and C, the bank should document the methodology for allowance for loan and lease losses evaluations. To speak on the 6th part of the risk management for subprime lending processes within a bank, you must A, perform ongoing loan review of subprime loans in its portfolio, and B, all credit scoring, pricing, and ALL adequacy models must be reviewed. To speak on consumer protection, with regards to the risk management for subprime lending, banks must take care to avoid violating customer protection laws and subprime lending, including loan discrimination and illegal steering. To speak on the securitization and sale on risk management in subprime lending, we must say A, management should refer to FAS 125 for accounting for these transactions, and B, banks should consider appropriate discount rates, credit loss rates, and prepayment rates when valuing these assets. And to speak on the re-evaluation part of risk management for subprime lending, you have to say banks should periodically evaluate whether the program has met its objectives and performance goals. Now we're at subpart 2. After discussing risk management for subprime lending and the coverage of the interagency guidance, we now are going to discuss the guidelines for national banks to guard against predatory and abusive lending practices. The purpose of this guidance is to 1. Provide examples to national banks of practices that may be abusive. 2. Advise banks on how they should avoid abusive practices. And 3. Show how some abusive lending can involve unfair or deceptive practices and therefore violate the Federal Trade Commission Act. The definition of abusive lending. 1. Abusive lending, and this is one of the parts of the guidelines. Abusive lending usually is defined by a variety of lending practices. 2. The fundamental characteristic is aggressive marketing of credit to prospective borrowers who cannot repay it on the terms offered. And 3. Typically, such loans are underwritten on the liquidation value of the collateral rather than the creditworthiness of the borrower. Subpart C of the guidelines. Practices that may accompany the marketing of predatory or abusive loans. The presence of one factor alone does not necessarily indicate a predatory or abusive practice. 1. Loan flipping. 2. Refinancing of subsidized mortgages that result in the loss of terms beneficial to the borrower. 3. Packing. 4. Using loan terms to make it more difficult for borrowers to reduce or repay the debt. 5. Using balloon payments to conceal the true burden of the financing and to force borrowers into costly refinancing or closures. 6. Targeting inappropriate or expensive credit products to older or unsophisticated borrowers or to those who would qualify for mainstream credit products. 7. Providing inadequate disclosures of risks and costs of the credit. 8. Offering single premium credit life insurance. And 9. Use of mandatory arbitration clauses. And this is with regards to credit. They don't want you using mandatory arbitration. I'd like to know if non-deposit investment products can do that. Let's talk about what is loan flipping. Frequent refinancings that do not benefit the borrower. This practice can result in borrower injury from the fees imposed and from the fact that it decreases home equity and increases the customer's debt burden, thus increasing the chance of foreclosure. Impacting is excessive or fees are hidden in the amount financed. Subpart D of the guidelines involves refusing to purchase the following types of loans can reduce the possibility of purchasing abusive mortgage loans. 1. Loans in which a lender has not adequately determined the borrower's ability to repay the debt. 2. Loans subject to HOEPA, the Home Ownership and Equity Protection Act. 3. Loans with points and fees in excess of 5% of the loan amount, except in cases where the higher amount was to prevent the loan from being unprofitable. And 4. Loans in which a prepaid single premium credit insurance policy was included in the amount financed. Subpart E of the guidelines refers to FTC violations, explaining that OCC considers that a practice may be deceptive and therefore unlawful if each of the following factors is present. A representation, omission, act, or practice that is likely to mislead. B, the act or practice would be likely to mislead a reasonable consumer, that is, a consumer targeted by the act or practice. And C, the representation, omission, act, or practice is likely to mislead the consumer in a material way. Of these FTC violations, number 2, the OCC will consider that a practice may be unfair and therefore unlawful if each of the following factors are present. The practice causes substantial customer injury. The injury caused by the practice is not outweighed by any countervailing benefits to the consumer or to competition. C, the injury caused by the practice is one that the consumer could not reasonably avoid. And 3, examples of such unfair practices are loan flipping and equity stripping. Loan flipping may be unfair because it increases the chances of foreclosure by decreasing home equity and increasing debt burden. Equity stripping is the practice of making loans secured by the consumer's home but with high upfront fees that are financed and secured by the home. Violations of other laws. 1. Predatory lending practices such as frequent refinancing can violate HOEPA, and steering borrowers to loans with higher costs can involve illegal discrimination under fair lending laws. All this was communicated in the guidelines. Community Reinvestment Act. Predatory lending practices can adversely affect a bank's CRA rating. H. Avoiding predatory and abusive lending practices. Establishing policies and procedures. Adopt sound credit underwriting policies. Adopt policies that address the circumstances under which a bank would make loans that have features associated with abusive lending practices, and adopt policies concerning the appropriateness of transactions involving unsophisticated borrowers. The use of loan precedes the borrower's understanding of how the loan meets their needs and the bank's assessment of how the loan will meet the borrower's needs.